You are listening to The Vocal Technologist. Spoken Tech for your ears.
You know, it feels like the financial world is playing two completely different games at the same time. On one hand, you see the big banks posting these massive, comfortable numbers. Everything looks, well, normal. But then you look underneath, and it's like the entire plumbing system is being ripped out and replaced with something that runs at the speed of light.
That's a perfect analogy. It really is. We're in this weird phase where 2025 looked like a tremendous year for the big established players.
Yeah.
But if you look just a little bit closer, the technology, the scale, it's compounding so fast, it's threatening to make those old models just obsolete almost overnight.
Exactly. And that's really our mission for this exploration today. We want to ignore the big headlines and just look at the blueprints. We're going to try and extract the critical intelligence from some of the latest industry assessments on the state of Fintech 2026. You know, where is the serious capital actually flowing? How are the core financial protocols being completely overhauled? And what does this explosion of AI-driven work really mean for you operating in this space?
Right. I think we need to understand what defines a durable financial institution now in this new era. We're past the phase of, pure novelty. Investors now, they're demanding companies that can show real, sustainable profitability and scale. Platforms that look less like a startup experiment and more like the central infrastructure of tomorrow. That shift in mindset, that's really the central theme here.
Okay, so let's unpack this immediately. If durability is the goal, we have to follow the money. We're seeing these mega funding rounds, but there's so much fewer in number. It almost suggests that if you aren't already scaled, you might just be out of luck. What specific kind of company is passing this durability test? Who's getting these massive checks?
It's extremely concentrated. If you look at U.S. venture funding over the last year, Fintech was one of only 3 sectors, really, alongside AI and core data infrastructure. Those are the places that saw capital flowing into these mega rounds. It wasn't spread thin at all. It was very, very focused on proven winners.
So what's the insight for a founder trying to break through? I mean, what makes a $2 billion deal happen today?
The insight, I think the clear takeaway is that capital is moving away from just an interesting app idea. It's migrating toward future regulated behemoth. You have to be solving a painful, expensive operational problem, and you have to do it at scale. Take Acrisure, great example. They just closed a $2.1 billion raise.
2.1. Wow.
Yeah, and they're an insurance broker, but they've built their platform by aggressively integrating technology across the entire risk life cycle. And they used a massive M&A strategy to scale distribution. They look less like a traditional brokerage and more like a cash flow optimized tech engine for insurance.
So it's about controlling the risk and the distribution with software, not just selling policies.
Okay.
And what about Polymarket? They also raised a huge, $2 billion round?
Polymarket is fascinating because it signals this appetite for blending real financial rails with technology. And this is crucial, with regulatory clarity. They're in the prediction market space, which is evolving really fast. That investment shows that even with novel financial products, investors will commit huge sums if the platform shows, operational robustness, scaled transaction volume, and a clear path to regulatory compliance. They're building a new kind of financial rail.
Right. That sets the stage for U.S. capital then. Scale and a clear path on regulation. But this rapid compounding of scale, it's not just a North American thing. We've seen players like Nubank, Klarna, Revolut. They've just run the table in Europe and Latin America.
Absolutely. The European fintech market has really matured, and we have a fantastic case study in Trade Republic, the Berlin-based retail investing platform. They just hit a 12.5 billion euro valuation.
That valuation alone is a huge signal, but there was something about the structure of their financing that really stood out, wasn't there?
Yes. The true proof of confidence came when they did a 1.2 billion euro secondary share sale. This means they provided liquidity, a massive payout to their early investors, and they did it without having to raise new primary capital for the company itself.
So they didn't need to dilute their equity or take on new risks to grow. They just proved they had so much durable value that existing investors could cash out, and new buyers were lining up to get those shares at a premium.
Exactly. It signals this incredibly strong external belief in their long-term profitability, in their regulated model. They've hit that necessary scale and trust where they're seen as a durable, lasting financial fixture, not just a fleeting trend. In a tight market like this one, that's the ultimate stamp of approval.
That shifts the conversation from who gets funded to, well, how money moves once it's there. We've covered scale and valuation, but now we have to look at how the fundamental workflows, everything from treasury management to just daily payments, are being profoundly restructured. And it looks like the two big forces here are stablecoins and this idea of agentic commerce.
Right, if you look at the infrastructure layer, the overhaul is just pervasive.
Let's tackle agentic commerce first. We're moving way beyond an AI just recommending a product. Agentic commerce is the shift where AI agents become autonomous. They become systems capable of executing transactions and managing complex financial decisions all on your behalf. Imagine your household AI not just tracking your bills, but actively renegotiating your utility contracts and paying them securely.
Okay, this sounds incredibly powerful, but also inherently chaotic.
Yeah.
If I empower an AI to transact for me, how do I stop a malicious agent, or even just an overzealous one, from buying things I don't want? How does the system trust the agent?
That is the critical infrastructure challenge, and it requires huge industry collaboration. What's happening is that major players, think Fiserv, Visa, Mastercard, they're all partnering to create the authentication standards. They need a system to give merchants the tools to tell the difference between a trusted, authenticated AI shopper and, a malicious bot trying to commit fraud. But isn't collaboration between those titans, Fiserv, Visa, Mastercard, notoriously slow? How quickly can a universal standard for agents really emerge?
That's a great point. It's a challenge to the timeline. But while the security standards are complex, the market demand for this kind of automated efficiency is accelerating the rollout. They're focused on creating what they call programmable payments APIs, the ability to verify the identity and intent of an algorithm before it completes a transaction. That's the new security frontier. The race isn't just about speed, it's about establishing the trusted protocol first. Because once a standard is set, network effects will lock it in very, very quickly.
Which brings us to the other major force here, stablecoins. We've seen years of hype, but it feels like the momentum has finally turned into real, tangible adoption, maybe pushed along by some regulatory clarity coming in the US.
Absolutely. Stablecoins are moving from speculation to utility. It's not just about peer-to-peer transfers anymore. They're entering high finance and commercial settlement. We saw Klarna, for instance, announce plans to use USDC, a stablecoin, to raise short-term funding with Coinbase. They're literally bypassing traditional capital markets for some of their operational funding.
That's high-level treasury, but what about for the everyday merchant? What does it do for them?
Look at Shift4, a massive payment processor. They launched a stablecoin settlement platform just for their merchants. The competitive edge is huge. Traditional banking, it runs, 9 to 5, 5 days a week? If you're a merchant, especially selling globally, waiting 48 hours for your funds to settle, that kills your cash flow, your inventory management.
And Shift4's platform lets merchants settle funds 204/7. That capability just completely blows up the friction in the established system.
Precisely. It turns money from a physical, time-bound asset into software that moves instantly. And if we connect this fundamental infrastructure shift to the bigger picture, it raises a really profound question about the old fintech mode.
Okay, tell us more about that. What was the old moat and what's replacing it?
The old mode was all about regulatory arbitrage and who you knew. It was. We have the licenses and we have exclusive partnerships with the big banks. Their value was just navigating the friction of the old system. The new mode is completely flipping that.
So if the new goal is zero friction, 204/7 speed, what's the new moat built on?
It's built on protocol-level execution, security, and owning more of the data stack. It's about building the infrastructure layer yourself. You can't rely on a partner bank if your competitor is settling funds instantly on-chain. This demands deep, deep technical skill.
Can you give us an example of a project that's really tackling this, something that shows the difference between renting the rails and owning them?
Yeah, the most promising one demonstrating this shift is a project called Altitude. It's described as self-custodial, programmable business banking built primarily on Solana.
And why Solana?
Because the network offers the speed and the incredibly low transaction cost you need to make high-volume business processes viable. Altitude isn't trying to be a bank. It's building new treasury infrastructure. It lets businesses hold their own funds, that's the self-custodial part, and program them to do complex tasks, add yield, facilitate agentic transactions. And it only plugs into traditional fiat when it has to, like for payroll. They're expanding from crypto-native treasuries to global tech startups. They are building the infrastructure, not just renting it.
That's a massive distinction. Okay, we've covered capital, which flows to scale, and infrastructure, which is being rebuilt by protocols and agents. But what about the work itself? AI is the engine here, and the promise was always efficiency, but I'm hearing this might actually lead to an explosion of more work, not less.
That's the AI wildcard. And it's best explained by something called Jevons Paradox. It's an economic principle from the 19th century about coal.
Okay, let's apply Jevons Paradox to today's knowledge work.
So the original paradox was that making coal use more efficient didn't reduce how much coal was consumed. Instead, it made coal so much cheaper that people found exponentially more uses for it, and total consumption went way up.
So the same thing happens with intellectual effort. If I use an AI agent to cut the cost of a marketing campaign from 3 weeks down to 3 hours.
Exactly. You don't take the rest of the time off.
Yeah.
You now generate 10 times the experiments.
Yeah.
AI agents dramatically lower the cost of what we call non-deterministic knowledge work research, analysis, software, marketing copy. And this paradox kicks in, triggering a radical scaling of total output, maybe 10 to 100 times more, because the cost of trying things drops to almost zero.
I can actually relate to that. I started using some new tools to outline these conversations, and instead of just writing one script, I now outline 3. Because the barrier to just getting the concepts down is so low, it's an explosion of ambition.
That is precisely the mechanism. AI expands ambition by giving every company capabilities once reserved for, Fortune 500 firms with huge R&D budgets. As a result, humans don't disappear, they just shift. They move toward higher-level judgment, orchestration, and deciding which of the 100 AI-generated experiments is the one worth pursuing.
That conceptual shift is huge. Let's look at that model of total control and software integration in an unexpected place. Insurance.
Tesla's is becoming the quintessential example of this, owning the entire vertical stack. They're turning insurance from a service they bolt on into an integrated software feature of the car.
How are they doing that in a way that traditional carriers just can't touch?
They're embedding the entire insurance lifecycle, quoting, underwriting, claims, billing directly into the car's OS and the owner's app. And crucially, they're aggressively staffing and controlling the entire loop, engineering the pricing models, managing claims, the legal side, even collision partnerships.
So they control the hardware, the software, the data, and now the financial rails for coverage and repair.
That's the long-term bet. By owning all that data and infrastructure, they reduce costs, they speed up resolution because they know exactly what happened in an accident, and they deepen customer lock-in. It's total control of the financial workflow built on superior software.
That model, taking the whole value chain and building it on software, is the same disruptive idea we saw with Chime. They didn't reinvent the bank charter, but they reinvented the mobile-first experience and unlocked this massive consumer opportunity. It's software eating the stack, no matter the vertical.
And that ethos is everywhere now. You see it in the startups at events like TechCrunch Disrupt. They're all tackling these entrenched problems, fraud detection, banking infrastructure, even real estate discovery. But with this same software-first data stack ownership mindset, they don't want to just rely on the old guard's slow APIs. They want to build the faster, cheaper alternative.
So we've covered a foundational restructuring. For you, the listener, the orchestrator, we've seen a clear twin focus emerge. Capital is flowing to scale players who show durability and profitability, while new protocols are radically changing how money moves. And the underlying driver for all of this is AI, which promises not rest, but acceleration. The Jevons Paradox.
The implication for any business is crystal clear. The definition of a durable financial institution has shifted. It's no longer just about regulatory licenses and old banking partners. True durability is now measured by robust protocol execution, owning your data stack, and the ability to provide transaction speed that legacy rails simply cannot match. Friction is no longer a sustainable business model.
It's an overwhelming, but I think exhilarating restructuring. And since AI agents are set to scale our work 10x, maybe 100x, transacting on our behalf in this new world of agentic commerce, we have to ask the ultimate question. How will we, as these higher-level orchestrators, determine which tasks are truly necessary and which are just the inevitable expansion of demand created by this boundless, cheap efficiency?
That is the profound challenge of the next 5 years. Are we building a manageable, hyper-efficient future? Or are we just at the beginning of an overwhelming deluge of necessary work that ultimately brains out the human element? Something to mull over.
Absolutely. Thank you for joining us for this focused analysis of the fintech shift of 2026.
Spoken Tech, for your ears.